Good afternoon. Since the previous meeting of the Monetary Policy Committee, the inflation forecast has remained relatively unchanged, but the risks to the forecast have increased. The risks are a marked depreciation of the rand, worsening drought conditions, and their likely impact on food prices, and the possibility of additional electricity tariff adjustments. At the same time, the economy remains weak, despite an improved performance in the manufacturing sector. But both mining and agricultural sectors appear to have contracted further in the third quarter. Although global financial markets have stabilized somewhat since the previous meeting, the outlook for emerging markets in particular remains challenging. The US Fed is likely to raise its policy rate in December, and further volatility in financial markets can be expected in the lead up to this. The year-on-year inflation rate, as measured by the Consumer Price Index, for all urban areas measured 4.7% in October, following 2 consecutive months at 4.6%. Food and non-alcoholic beverages inflation surprised again on the downside at 4.8%, with a contribution of 0.7 percentage points to the overall CPI outcome. Services price inflation remained unchanged at 5.6%, while goods price inflation increased to 3.7% from 3.6% previously. The bank measure of core inflation, which excludes food, fuel and electricity, measured 5.2%, down from 5.3% in the previous 2 months. Producer price inflation for final manufactured goods increased from 3.4% in August to 3.6% in September. The main pressure came from the category of food, beverages and tobacco products, which contributed 2 percentage points to the outcome. Food and agricultural crop price developments are expected to sustain the upward trend in PPI in the coming months. The latest inflation forecast of the bank shows a slight near-term improvement, while the medium-term forecast is marginally higher. Inflation is now expected to average 4.6% in 2015 and 6% and 5.8% in the next 2 years. The anticipated breach of the upper end of the target range in the first quarter of 2016 is now expected to average 6.4% compared with 6.7% previously. The trajectory for the rest of the year is also slightly lower than previously forecast, with the temporary breach in the fourth quarter of 6.1%. The forecast for 2017 follows a slow downward trend, with inflation still expected to measure 5.7% in the final quarter. The changes in the forecast are due to a lower starting point for the forecast, lower international oil price assumptions, and an adjustment to fees for higher education, which are more or less offset by a more depreciated starting point for the real effective exchange rate. The forecast for core inflation is marginally higher, with an expected average of 5.5% in 2016 and 5.4% in 2017, mainly due to the more depreciated exchange rate assumption. The BER Inflation Expectations Survey is only due for release in December. The median inflation forecast of the analysts polled in the latest Reuters Econometer survey is similar to that of the bank and also declined marginally since the previous survey. The break-even inflation rates, which have improved since the previous meeting, remain above the upper end of the target range. Divergent global developments continue to create a changing environment for monetary policy. Although the US recovery appears to be sustained with further improvements in the labor market, The strong dollar poses downside risk to both growth and inflation. The UK economy also remains on its recovery path. By contrast, the recovery in the euro area is much weaker, although the outlook is more favorable than it was earlier in the year. The Japanese economy has contracted for 2 consecutive quarters, with positive but slow growth expected in the coming quarters. The Chinese economy shows signs of stabilizing, aided by policy stimulus, but the medium-term outlook remains a concern. There is still some uncertainty regarding the extent to which services output and consumption has compensated for the decline in industrial output and investment. The tail risk of a hard landing remains, which would have a significant impact on countries with direct trade linkages, particularly those in Asia, as well as on commodity prices. Russia and Brazil remain in recession, while the strong performance of the Indian economy has been sustained following a number of structural reforms. The outlook for sub-Saharan Africa, while still positive, has deteriorated in the wake of lower commodity prices, and further weakening could create greater headwinds for South African manufactured exports to the region. Global inflation trends are also benign, with concerns about deflation abating in most advanced economies. Despite significant currency depreciations in the commodity-producing economies in particular, inflation pressures have generally been surprisingly contained, with a few exceptions. Emerging markets have had differing experiences. A number of countries in Latin America, particularly commodity producers, have tightened policy in recent months in response to incipient inflationary pressures, while others with low inflation, particularly in Asia, have loosened policy further. In the advanced economies, monetary policy divergence is expected to continue. Monetary policy is set to remain accommodative in the euro area and Japan, with possible further quantitative easing against a backdrop of slow growth and benign inflation pressures. In the US, inflation and labor market dynamics, as well as Fed communication, suggest that in the absence of any major surprises or shocks, an increase in the policy rate can be expected in December. Market expectations are for monetary policy tightening in the UK to commence sometime in the second half of 2016, later than previously expected. Although volatility in global asset markets has moderated amid improving risk sentiment, emerging market foreign exchange markets have been relatively volatile and vulnerable to capital outflows. In the past 3 months, South Africa has also seen net portfolio outflows. Since the end of August, according to the JSE data, non-resident sales of equities amounted to 25.9 billion rands, while net bond sales amounted to 5.9 billion rand. The rand exchange rate has been particularly volatile, even compared to its peers, as domestic factors also impacted on the currency. Since the previous meeting of the MPC, the rand has appreciated by 1% against the euro, but has depreciated by around 3% against the dollar and by 1.5% on a trade-weighted basis. As before, the extent to which Fed tightening has been priced into the exchange rate remains uncertain. Nevertheless, a high degree of volatility and overshooting of the exchange rate may be expected in the lead up to and in the immediate aftermath of the start of the US interest rate cycle. Fed communication of future moves will be key. To date, the indications are that a moderate policy hiking will be pursued. The domestic economic growth prospects remain subdued amid weak business confidence, but a further contraction in the third quarter is not expected. The bank's forecast for GDP growth has been revised down marginally for 2015 and 2016 to 1.4% and 1.5%, but remains unchanged at 2.1% for 2017. The estimate of short-term potential output remains unchanged at 1.8% for this year, rising to 2.1% in 2017. The bank's composite leading business cycle indicator declined further in August, consistent with the fragile outlook. The manufacturing sector recovered somewhat in the third quarter, mainly due to a surprisingly strong performance in September, and is expected to have contributed positively to GDP growth. However, the Barclays PMI declined further in October and has been below the neutral level of 50 for 3 consecutive months, suggesting a constrained outlook for the sector. The mining sector is expected to subtract from GDP growth following a further contraction in the third quarter, while the continuing drought points to a third successive quarterly contraction for the agricultural sector. The outlook for the construction sector is constrained following significant declines in new building plans passed and reflected in a 9-point drop in the FNB BER Building Confidence Index. Against this backdrop, formal sector employment trends remain disappointing. According to the quarterly employment statistics survey of Statistics South Africa, employment in the formal non-agricultural sector declined in the second quarter of 2015 as the private sector continued to shed jobs. Although the quarterly labor force survey indicates an increase in the number of persons employed in the third quarter, the number of unemployed persons rose sharply in the quarter as the number of new entrants increased. Consequently, the official unemployment rate increased to 25.5% in the third quarter. There are minimal demand-side pressures in the economy, with consumption expenditure by households continuing to be inhibited inter alia by low consumer confidence, declining disposable income growth, and slow employment growth. The latest retail trade sales data suggests that household expenditure may have lost further momentum in the third quarter. Durable goods sales remain under pressure, as indicated in the intensification of the downward trend in motor vehicle sales in recent months. Consumption expenditure is also constrained by the continued slow growth in credit extension to households by banks. Unsecured lending remains subdued and is likely to be impacted further by the recently announced caps on interest rates by the DTI, whilst the decline in growth in installment sale credit and leasing finance is indicative of softer motor vehicle sales. Credit extension to corporates remains robust, particularly commercial mortgage finance, which reflects in part a switch away from funding in the bond market by property funds. The recent medium-term budget policy statement signaled a continued commitment to fiscal consolidation by government, although at a slower pace. Most of the expanded deficit is attributable to lower expected tax revenues in response to the weaker growth outlook. Trends in wage growth remain a concern and contribute to the persistence of inflation at elevated levels. Year-on-year growth in salaries and wages per worker accelerated to 8.7% in the second quarter of 2015, and after adjusting for labor productivity increases, total unit labor costs increased from 4.3% to 5.1%. By contrast, the average wage settlement rate in collective bargaining agreements recorded by Andrew Levy Employment Publications recorded a moderation to 7.7% in the first 3 quarters of the year, compared with 8.1% in 2014. Apart from the exchange rate, the main upside risks to inflation come from possible electricity tariff and food price increases. Eskom's regulatory clearing account application to NERSA to claw back excess expenditure of 22.8 billion rands is likely to lead to a further tariff increase, although the quantum and timing is uncertain. This is in addition to the 12.2% tariff increase already built into the inflation forecast for next year. No provision is made for the RCA application in the forecast at this stage, but it is regarded as an upside risk. A higher food price trajectory has been incorporated in the forecast for some time, but food price inflation has surprised on the downside in recent months, despite sharp increases in maize and cereals prices earlier in the year. However, the increased intensity of the drought, which has led to downward revisions of the domestic maize crop estimate, as well as incipient pressures evident in both the PPI and CPI, suggests that an acceleration in food price inflation is likely, adding to upside risk to the inflation outlook. By contrast, international oil price developments are expected to remain benign, with current spot prices below $45 per barrel, somewhat lower than those assumed over the forecast period. Although petrol prices have contributed to a succession of downside inflation surprises in recent months, the beneficial impact of lower international oil prices on domestic petrol prices has been offset to some extent by the depreciation of the rand. The latest data suggests that should current trends continue, a small drop in the petrol price can be expected next month despite the further depreciation of the rand. Although the inflation forecast is relatively unchanged since the previous meeting, the upside risks to the inflation outlook are more pronounced. As noted, this risk relates to the persistent exchange rate depreciation, electricity tariffs and food prices, and are assessed to outweigh possible downside risks from lower international oil prices and subdued exchange rate pass-through. While these factors cannot be dealt with directly through monetary policy, the concern of the committee is that the failure to act could cause inflation expectations to become unanchored and generate second-round effects and more generalized inflation. Although core inflation has remained steady and inflation expectations to date have been relatively anchored, they remain at uncomfortably elevated levels. The general approach of the MPC is to attempt to see through exogenous shocks and react to second-round effects. However, shocks of a persistent nature, for example, extended periods of currency depreciation or drought, or multi-year increases in electricity prices, make it more difficult to disentangle these first and second-round effects. In the absence of demand pressures, the MPC had to decide whether to act now or later. On the one hand, given the relative stability in the underlying of core inflation, delaying the adjustment could give the MPC room to reassess these unfolding developments at the next meeting and avoid possible additional headwinds to the weak growth outlook. On the other hand, delaying the adjustment further could lead to second-round effects and require an even stronger monetary policy response in the future, with more severe consequences for short-term growth. Complicating the decision was the deteriorating economic outlook. Although the change to the growth forecast was marginal, the risks to the outlook, which were more or less balanced at the previous meeting, are now assessed to be on the downside. Against this difficult backdrop, the MPC decided to increase the repurchase rate by 25 basis points to 6.25% per annum, effective from 20 November 2015, 4 members of the MPC preferred an increase, while 2 members favored an unchanged stance. Despite the increase, the MPC still views the monetary policy stance to be accommodative. The continuing challenge is for monetary policy to achieve a fine balance between achieving our core mandate of price stability and not undermining short-term growth unduly. Monetary policy actions will continue to focus on anchoring inflation within the target range while remaining sensitive to the extent possible to the fragile state of the economy. As before, any future moves will therefore be highly data dependent. At this stage, let's pause and take any questions that you might have. And as usual, please identify yourself and the media house that you come from. Ma'am?
Good afternoon, Governor and the MPC members. My name is Nzakisa. I'm from Business Day newspaper. On core inflation, number one, the fact that you see it increasing 2016, does that mean you see a higher level of rent pass-through next year? And the second question relates to your decision to hike rates. To what extent has expectations for a Fed hike next year and what the rand reaction might be, to what extent did that have to do with the decision that you took?
Thank you. I'll take another one. Ma'am? Speak onto the mic, ma'am.
Stella Mapenza, also from Reuters News. Did the central bank discuss a 50 basis point rate hike?
Ma'am?
Mary Misa from the Sunday Times. Does the MPC expect the rand to weaken in the next few months?
Thank you. Ntsakisi, an expectation about the rise in the core rate, core inflation, does that mean that pass-through has gone up? No. As we had said before, that we had been pleasantly surprised by the pass-through that we have seen. Across the globe, it looks like pass-through effects from the exchange rate seems to have declined. Whether this is a permanent phenomenon or not is another matter. What the core inflation forecast actually reflects is it reflects the matters that we had identified as being the key drivers of inflation over the next 2 years. To what extent was the Fed hike a factor? As we had said previously, we do watch what is happening in the global economy. The U.S. is the largest economy. Developments in the U.S. affect developments in a variety of countries, including ours. We had indicated previously that we do not follow the Fed step by step, and that we actually look at what are the developments in global economies, what do they mean for developments in the domestic economy. You would realize that we started our tightening cycle in January last year, and the Fed was not doing anything. So it had nothing to do with the Fed. But will the move by the Fed affect us? Of course it will. When the Fed hikes, the extent to which there are movements in financial markets would depend to the extent to which the financial markets have discounted the move by the Fed. Recent evidence seems to suggest that this is not fully discounted, because every time there is data that is released that could suggest that there would be a delay, we see a reaction in the market. And if there is any indication that it could come earlier, there is a reaction in the financial market. That tells us that it is not fully priced. Would we be reacting to the Fed hike? No. What we would be reacting to is what impact that has on the key drivers of inflation in South Africa. And one such channel that we have identified as a risk has been the exchange rate. So to the extent that a Fed takeoff leads to a global realignment in exchange rates, leads to an outflow of capital from emerging markets, and thus a secular or repeated depreciation of the currencies, then central banks have to take back and look, and in our case, we would look and say that, does this depreciation lead to a rise in inflation? And if we are of the view that that is what it does, we would then have to adjust a policy. Stella was a 50 basis point increase discussed. Simple answer, no. Miriam, does the MPC expect the rand to weaken? Well, the best place to look for a drunken man if you have left him in the middle of a soccer field is to go in the middle of a soccer field. Truth of the matter is that these exchange rates can be anywhere. We have seen that there is uncertainty. There is a lot of volatility in the financial markets, and forecasting exchange rate has become a forecaster's worst a nightmare. So we are concerned about the volatility, and what we would always focus on is, does the move in the currency, does the depreciation of the currency become persistent, and does it lead to second round effects, in which case we will then be made to act. There was a hand there, but before that, is there anybody who wants to add anything? A hand there?
Good afternoon, Governor. It's Renee Volgraaf from Bloomberg. Governor, about the MPC's growth forecasts, you've downgraded the growth forecast for this year and next year, but then there seems to be quite an optimistic jump going into 2017. What is the SARB see driving that sudden uptick in growth? And then also, given that you have now announced a rate hike, how do you see that affecting growth? I mean, we have not seen very good data in the third quarter, although, as you said, you do not expect a contraction in the third quarter. But are you not concerned about the effect of this rate hike on growth going forward?
Is there any other? Ma'am?
Hilary Joffe, Business Day. If the exchange rate is, as you say, one of the biggest risks to the forecast, are you concerned about the timing of the Fed meeting from a South African point of view? The 16th of December, it seems quite a fragile time for us. Historically, that has been a very illiquid time in the markets where the rand is very vulnerable. So my question is, are you concerned particularly about the timing of the Fed hike, if there is going to be one, and the impact that could have? And are you going to be particularly vigilant over that period, or putting any special measures in place? Thank you.
Any new hand? Okay. Yes, Miriam.
Would you consider this hike as sort of a preemptive hike? And is there any chance that it could be the last hike for a while? Do you expect future hikes to happen quite slowly?
Sir.
Patrick McGordy from the Wall Street Journal. Thinking about the suspension of university tuition fees for next year, are you concerned about the impact that's going to have on South Africa's fiscal health and the way that international investors might react to that deteriorating fiscal health?
Yes, Seppo.
Good morning, Governor. In your previous forecast, you had penciled in about 12% increase in the price of in electricity tariffs.
12.2.
Yeah. Have you changed that? Have you considering that there are some changes in terms of what Eskom is requiring from NERSA?
There's somebody on webcast.
It's Danielle Masia. Given increasing signs of a slack in domestic demand, does the MPC see risks of a larger negative output gap developing versus what is portrayed by your existing forecasts?
Thank you. Rashad, output gap and electricity. Then, timing of the Fed meeting and liquidity, and of course I know you are vigilant. Brian Khan, impact of the hike on growth. Shall we start with you, Rashad?
Thank you very much. It is on the output gap. It is not inconceivable if GDP contracts further for the next couple of quarters, that the output gap can widen. So, in principle, that is a possibility. I think that our job is made complicated by the fact that we're all trying to get a handle on the supply side and the productive side of the economy, and the extent to which, the output gap can narrow despite the fact that demand contracts in the economy. And I think that is an uncertainty that we're dealing with. But at this stage, it is not inconceivable that the output gap can narrow if the economy continues to project, and our forecasts happen to be on the optimistic side for GDP. On the question of electricity, so we have the current electricity built in our forecast. We have not made any assumptions about what we think the NERSA will do to the round of new increases. So that is why it's quite important to highlight that we see that as a risk in our forecast, because we haven't built that in, because we don't have a sense of what it's going to be. Thank you.
Brian?
I think the question was whether we are concerned about the impact on growth and what we assess the impact would be. I think we always are concerned about that impact, and it is very much on our minds. In terms of the model, a 1 percentage point increase in the repo rate would reduce growth by 0.4 percentage points. So it follows that a 25 basis point increase would have an impact over 1 year of about 0.1 percentage points.
Kuben, you want to deal with the preemptiveness or otherwise of the decision?
Monetary policy always has to be forward-looking. We always have to look 12 to 18 months ahead, because monetary policy is largely impactful in a 12 to 24-month cycle. Monetary policy can do very little about the inflation rate over the next 3 to 6 months. And so what we have to do is to take a forecast, an educated guess about how we think the inflation dynamics are likely to pan out, how we think each of these three big risks that we spoke about, the exchange rate, food prices, and electricity, are likely to unfold over months 12 to 24, in other words, and to take a decision on that. We're not attempting to preempt the Fed in any way in that regard. It is highly likely that they would hike rates. And so in some ways that's built into our scenario. So we are preemptive in the sense that we are forward-looking. We're looking 12 to 24 months ahead. And in that sense, we have to be quite careful, because on the one hand we are data dependent. In other words, we're looking for evidence of inflation pass-through, of second-round effects, etc. But we have to look forward. And so it's a delicate balance between interpreting the data and making some assumptions about how the data is likely to evolve over the next year or two.
Dan, if you can deal that. Francois, you want to deal with university fees? It's a very simple question.
Hilary, I think very interesting question. We have indicated that the extent to which the change and the lift-off in U.S. monetary policy is priced into the exchange rate of the rand remains uncertain. So, indeed, you know, the timing of the meeting of the Fed on the 16th of December, a period typically, as you quite correctly say, characterized by thin liquidity conditions in our markets owing to the holiday period, not just because of this move, but generally it can lead to somewhat exaggerated sort of movements in the market. So with this particular meeting being at that time, yeah, it does complicate things a little bit. But of course, from a point of view of taking monetary policy decisions, they would be based on a much more holistic assessment as opposed to what potentially might happen in a 2 or 3 week period of a little bit of a wobble in markets. But every year we make provisions and try and make sure that we stand ready to manage the domestic liquidity requirement in such a manner that we continue to have orderly functioning of markets. So it would be the same this year. So the governor's quite right. We're always vigilant. But yeah, it can lead to a little bit of some volatility or increased volatility in the markets, depending on obviously how the decision is taken and, more importantly, what gets communicated as to what the future trajectory might be flowing from that decision. But as I say, this is a period during which we are normally prepared to deal with any eventualities that might arise from this thin liquidity conditions in the markets.
Thank you, Governor. Well, first of all, I think as monetary authorities, we've got full confidence in our colleagues at National Treasury, and I think they are the most appropriately placed to respond to that, because I'm sure they would be evaluating that situation, and obviously as with these things there are different trade-offs, and I'm sure that they would assess it and decide how best to approach the matter. So my own view is that those type of questions should be directed to our colleagues at National Treasury. Thank you.
Thank you. Stella?
Governor, a follow-up question to my earlier one. What would be the argument from the central bank's view in favor of a 25 basis point hike and maybe another one next year, as opposed to biting the bullet, so to speak, and hiking 50 basis point, which is what the central bank used to do in the past?
Renee?
Thank you, Governor. It's Renee again from Bloomberg. I'm just following up on the second part of my question that Mr. Khan answered for me. The 2017 growth forecast of the bank, can you maybe tell me where you see that boost to growth coming from? To 2.1 from, an estimated 1.6 next year. And then also, in your speech, several times you mentioned the drought and the fact that it is an upside risk to inflation. Have you factored in the effect of the drought into your CPI forecast, or is that still to be seen, what the quantum of that would be?
Zakis?
Zakisi again from Business Day. Does the moderate rate hiking cycle continue into next year, or is the bank going to be more aggressive? Thank you.
Any other hand? Okay. Nothing there? Thank you. Stella, there's the monetary policy is never easy. And it is taking place in a context of a profession which is an imprecise science. The bank used to hike by 50 basis points, as you had pointed out, but that's because we are very selective in the memory. There were times when we hiked by 100 basis points. What's different this time is that we are moving from a relatively low base rate. So a 25 basis points hike is moderate, but is not insignificant. Why didn't we just do a 50 basis points hike? Well, no one argued for one, for starters. Secondly, is that we are concerned about the weak growth outlook, and we have had to strike this delicate balance of having to deal with inflation and also deal with economic growth, which has, as we had seen, has got consequences for employment. So we had to strike this balance, and for a period of 3 years now, we have been talking about this policy dilemma that we are facing of growth that is slowing down and has slowed down further, and inflation that was bubbling at the upper end of our target range and is now expected to breach the target twice in 2 quarters next year, although we are seeing through that the average for next year is still seen as 6%. So we are continuously having to strike this delicate balance. Rene, you know, the growth for 2017 is not particularly optimistic. Let's be real. The growth that is being put here of 2.1% in the bigger scheme of things and where we had come from, and it is not a significantly optimistic scenario. We have built into the forecast the fact that the electricity constraint would be alleviated going forward, and as that electricity constraint gets alleviated, we will see growth taking up. But you know, 2.1% growth in the bigger scheme of things is not an optimistic level of growth. Drought, we had, if you check in the previous statements, we did highlight the impact of the drought conditions, and so we have that in our forecast. What we have not catered for in our forecast is a more pronounced drought, and we do not have the information to tell us if such a scenario plays in. And if that scenario plays in, it will have an impact through various channels, food being the first one, GDP being the other, and to the extent that we have got a shortage of maize or some of the products like wheat, we will have to import that, and that would have an impact on the trade account. Mtsakisi, moderate versus aggressive, this seems to be, I seem to have dealt with this question in the manner in which I have dealt with Stella's question. Suffice to say that any future moves, as the statements say, will remain highly data dependent. So moderation, aggression, that is not what we end up discussing in the MPC. What you end up discussing is what are the risks to the outlook on both growth, employment, and on the one side, and inflation on the other, and say what is the appropriate stance for us to take given the mandate that the Constitution has given us. I thought that was the last round of questions, but it looks like another question came by email. Miriam?
Thank you, Governor. This is a really simple question. Can you just confirm that we're still in a tightening cycle?
Yes. Any further questions? Thank you very much. That concludes the press conference. I know you have been coming in here. This is the last MPC of the year. Interestingly, it is also Tlengani Matebula's last MPC press conference. So if you see him at the next MPC press conference, just ask him which media house he is representing. But Tlengani, thank you very much for all of over these years arranging these press conferences. And I have got no doubt that I know your colleagues will miss you, but these journalists, they will miss you dearly. But hopefully, you will get to interact with them wherever you go. Thank Thank you very much.